A really exciting day for the research team. The playbook was released. Big shout out to also Nikki and Stu as well, who's done a great job really compiling that 150 pages of really good content there, putting that together. So just as a reminder, what we do is we preview 146 stocks under our coverage that are due to report next month. And what we've done with the playbook this time around, we tried to keep it a lot more focused. So taking your feedback on board, 3 or 4 really key areas of focus for each result. And on top of that, we have included where the analyst sits relative to consensus as well. So you can understand sort of where the estimates sit against the broader market. So what Tom and I will do this morning, we'll walk through some of the key themes. We've talked about them there, and then we'll go through the analysts. So in total, there's 32 positive surprise candidates and 9 negative disappointment candidates in there as well. So well worth your time just go through. So in terms of some of the themes that we're looking at, FY23 earnings. So what we think is essentially FY22 earnings are in the bag, and where the market really is concerned at the moment is just what the direction of FY23 earnings are. We look at profit margins. So this time around, profit margins, a lot of the focus is going to be about the demand side of the equation, rather than really that cost push. We know costs are coming through, but what's happening with demand? We look at the quality premium. So obviously a big consensus trade of late, but there's high expectations going in for a lot of these quality names. We look at those. We look at short selling. We're not seeing the same amount of short selling volume that we've seen in the lead up to last few reporting seasons, but short sellers are still there and they have concentrated where their targets are. And then we look at the tactics and resources. But very quickly from me this morning, we mentioned in the report, but to an outsider looking in, if you look at FY22 estimates for EPS growth across the market, it's 21.6%. And then into FY23, earnings are expected to grow another 9.6%. And if you throw in the fact that the multiples at 13.5 times, generally you look at that market and think, gee, that's, there's potentially some compelling value there. But just with everything that's not normal at the moment, so is the market. So really it's this tug of war between what the market expects to happen with earnings expectations versus the reality of what's happening on the ground and what the companies are experiencing. So we don't disagree that higher interest rates is going to mean slower economic growth, and it is going to mean that earnings are going to slow down. But is the market right to be worried in this all of a sudden collapse in earnings expectation? And certainly we don't think so. And while we're not going to get all the answers in August, what we do think we're not going to see is this widespread downgrades across the board. And if you look across the 2 previous reporting seasons and the EPS changes that have occurred since that time, you can see we're not seeing evidence. Yes, we are seeing some downgrades in certain sectors, really concentrated there, but we're not seeing widespread downgrades right across the board. Take that a little further, and if you look at the net earnings revisions, so this is looking at the breadth of downgrades, we're not in conditions where we typically see, this all of a sudden collapse in earnings expectations across the financials, industrials, consumer discretionary stocks. Yes, there are downgrades coming through, but it's not so widespread. It's not all of a sudden telling you that we're going to see this collapse in confidence. So we do point to a number of reasons for this. Firstly, economic conditions still remain sound. We're seeing, really strong employment numbers. We're seeing very good retail sales data coming out as well. Secondly, there's a lack of company guidance, and we pointed to this before. Distinct lack of guidance by industrial companies mean that analysts typically err on the side of caution. And given FY23 estimates were really thought about really in more detail around, coming out of the FY22 reporting season, which was in the middle of the Omicron wave, we think that forecasts are going to be inherently conservative anyway. What we're also seeing is less divergence between analyst forecasts. So analyst numbers tend to be a lot more clumped together this time around heading into this reporting season. So what that tells us is there's perhaps a little bit more earnings certainty going into FY23, given analysts. There's less variability across forecasts. And finally, just around the trading update environment, if you look at trading updates between May and June, we've seen about 11% of those companies that are reporting in August, provided trading update in that period. Historically, that's been double, into most other reporting seasons. So we're just not seeing the same volume of trading updates. Suggests to us that perhaps conditions are a little bit more stable going in. So we do think that results are likely to be okay, but more importantly, I think outlook statements are likely to be better than feared. So it's no surprise to us that perhaps we have seen, 32, or analysts have identified 32 positive surprise candidates out of 146 stocks. So over 20% in our universe. And then finally, from me, before I hand over to Tom, I guess that area that I talked about, short interest, short sellers really pulling back from the market, but they have still concentrated a lot of their targets. So we're seeing elevated short interest levels across the large caps: Westpac, NAB, BHP, and Fortescue. Woodside also gets a mention there. So they're really targeting those stocks, iron ore, energy, as well as a couple of the banks. And then, in the mid-cap space, you've got Square, IDP Education, and Flight Centre as usual. So they don't always get it right, short sellers, but it's certainly worth taking note. Other notable themes around where short sellers are positioned around some of the growth names. They've had an incredibly difficult half for a lot of those structural growth names, but short sellers still taking aim. So Zip, EML Payments, Nanosonics, Pro Medicus, and Megaport. So with that, I might just hand over to Tom just to take you through some of the other themes.
Yep. Thanks, Tangy. So Tangy also mentioned there that a large part of the focus this season will obviously fall onto costs and inflationary forces and the environment that we're working through at the moment. So operating margins clearly peaked for Aussie companies late or mid to late last year. And really the question for investors is how much will margins compress through this episode, if you like, if you want to call it that. Companies have a lot of levers at their disposal to offset those forces, particularly around productivity-driven cost out or straight cost removal, if you like. We look at companies that are able to pass costs through or offset them via price rises. We heard a really good story from ALQ on exactly that on Wednesday. And we look at companies offsetting those costs through changing their product mix or looking at premiumisation of their services. So that's one side of the equation. What I think the market is beginning to worry more about right now with justification is what actually happens if demand has an issue in terms of lowering efficiency of those cost bases. And I've caught a couple of flights in the last few days, and they were all impacted by the inavailability of enough labour to get planes away on time and unloaded and checked in and those sorts of things. What might happen should Qantas or other providers having issues with labour? What might happen to costs if some of that capacity has to be dialed down? I do get feedback from the mining industry. There are certain operations in the very remote parts of Australia where half of certain mining fleets are currently idle at the moment because they simply cannot get operators to run those assets. And some big companies like Glencore and others are having to make really tough decisions on, do we halve the capacity of our mine simply because we can't staff it? There are big costs in doing that, temporarily even. Or do we bear much higher unit costs in the interim, hoping that we can carry on? So as an idea across industrials as well, how the demand environment is holding up enough to fully utilise your cost structure will come into focus. So far, we actually think demand is looking pretty reasonable in Australia, but it's certainly an area we're keeping a close eye on. In the report, we've got 12 of the best all-weather stocks we think you should have a look at in terms of weathering and combating inflationary forces. I've left some of the infrastructure stocks out of here. They are among the best ways to offset those forces. I've left them out because they are trading a little bit more expensive, without as much upside as some of the names that I have mentioned. But some of those names we call out do include ALS, Corporate Travel's in there, Coles and Woolies, obviously, CSL and ResMed. So some really high-quality names to look at to combat inflation. Just before we park on maybe you've got that slide to park on in a sec, Tangy, in terms of what analysts are talking to. But in the deck, we've got our beat and miss tables going back about 6 or 7 years, and it really shows you that corporate results in Australia haven't really had a problem for a couple of years now. We've had some extraordinarily strong reporting seasons in the last 2 years, which are a function of much better than feared economic conditions, but also much more conservative than required consensus or market forecasts. And we certainly think that that is the case again, albeit perhaps some of the potential fear or disappointment on the margin outlook might tame some of the upside that we might have otherwise seen from more conservative than or more fearful than actual consensus forecasts. So concur with Tangy that I think this season's going to be okay. What I've actually spent some time on this note is, for a long time now when we've been talking to clients, they haven't wanted to talk more about, the health of corporate Australia. It's been more about how do you price these stocks in the changing economic environment. So early in the piece, the strategy piece today, we've actually got our economic roadmap for investors to watch over the next few months, and it really follows the Michael Knox playbook on the trajectory of rate hikes, the trajectory of inflation expectations, and then potentially by 23, 24 rate cuts, hopefully, to get to that type of point in time. So the point we do make in there, though, is that equity markets they're a preemptive asset class. They will look to price in improved economic conditions a good 6, 9, 12 months ahead of when they actually do arrive. So a very retail-friendly roadmap to look at. We actually expect a bit of a rocky 3-month, in line with your feedback on what you expect in markets. Maybe it's a 3-month period of trickiness, and then hopefully the economic data is starting to roll over in our favour by the end of this year. And we've mapped that out for your clients.